Investors, hello. This is Stock AI Insights Earnings Analysis. I'm your Chief AI Analyst. Now, just a quick reminder, this is for educational reference only. It's not investment advice. Investing always involves risk. Today, we are parsing Ulta Beauty's Q3 2025 earnings, which dropped on December 4th. The headline number that really jumps out, net sales shot up an impressive 12.9%.
But here's the thing. That amazing sales number, it's really only one side of the coin. The core story, the real puzzle of this quarter, is laid out right here. On one side, you have that incredible 12.9% revenue growth, but on the other, a drop in net income of almost 5%. So how can sales be soaring while profits are getting squeezed? That's exactly what we're going to break down right now.
All right, let's start with the good stuff, because there's a lot of it. The revenue momentum this quarter was, without a doubt, really strong. In fact, it actually blew past the company's own expectations.
The final number for the quarter was a massive $2.9 billion. And to put that in perspective, it's just a huge sign of the kind of consumer demand Ulta is capturing in the beauty market.
Look at this chart. You can see that 12.9% jump year over year so clearly, going from $2.5 billion up to $2.9 billion. So where'd all that growth come from? Well, it was really a mix of three things. A really solid 6.3% bump in comparable sales, that's sales from stores that have been open for at least a year, a nice boost from buying the luxury retailer SpaceNK, and of course, sales from opening brand new stores.
And you can bet management is happy about it. The CEO, Kesha Steelman, came right out and said the results exceeded their expectations. She pointed to strong sales, grabbing more market share, and seeing growth just about everywhere you look. So, the view from the top is that the strategy is really paying off.
But strong sales are only half the story, right? To get the full picture, we've got to pop the hood and see what's going on with the engine. It's kind of like having a high-performance car that's setting speed records, but it's also got this major drag that's just guzzling fuel. Let's find out what's causing that drag.
And here it is. Net income, the bottom line, actually fell by 4.7% compared to this exact time last year. This is the number that really creates that tension in their earnings report. They sold more stuff, but somehow took home less profit. So what happened? Look at this chart. This right here tells you everything. While those net sales grew a very healthy 12.9%, their selling, general, and administrative expenses, we call it SG&A, just skyrocketed by 23.3%. SG&A is all the money you spend to run the business. Things like store payroll, marketing, corporate overhead. And yeah, those costs are going to go out when you open new stores and buy a whole new company like SpaceNK, but they grew way, way faster than sales, and that put a ton of pressure on profits.
So here's the key insight, the thing you really need to remember from all this. The cost of achieving growth is growing faster than the growth itself. That was the fundamental challenge Ulta was wrestling with this quarter. It costs a lot of money to expand and buy companies, and we're seeing that bill come due on their income statement.
Now, with all this cost pressure, you'd probably expect management to play it cool, maybe be a little cautious about the future. But that's not what's happening at all. Instead, they've actually raised their forecast for the entire year. Let's see how this complicates the picture.
Okay, look at this chart. The company has bumped up its guidance pretty much across the board. They're now looking at full-year net sales around $12.3 billion, which is up from their last forecast, and they also boosted their expectations for comparable sales growth. But maybe the biggest thing here is that even with those cost headwinds, they raised their outlook for diluted earnings per share, a really key measure of profit. That tells you they believe their sales momentum is going to be strong enough to power through these rising costs for the rest of the year.
But of course, that confident outlook doesn't exist in a vacuum. To really get a balanced view, we have to look at the challenges that the company itself is flagging. Management is definitely optimistic, but they're also being realistic about the potential headwinds out there. In their official filings, Ulta lays out several key risks. You've got the big picture stuff, like macroeconomic pressures that could hit consumer spending. You've got the intense competition in the beauty world. And then you've got very specific challenges, like making sure the integration of SpaceNK goes smoothly and managing their expansion abroad. These are the wild cards that could complicate that rosy forecast.
So that brings us to the verdict. Ulta demonstrated really strong top-line momentum and proved it can gain market share, but it faces a critical challenge in taming its soaring operating costs. That tension is perfectly reflected in its outlook, which is both confident and, you have to admit, pretty risk-laden. What are your thoughts? Share them in the comments. We'll see you next time.